The first two architects, making debt permanent, then making it unavoidable. Every country on earth is in debt. Not some debt, not manageable debt, structural debt, the kind that doesn't behave like a loan you pay back, but like a gravity field you orbit for life. The United States, tens of trillions. Japan, trillions. Europe, trillions. And globally, hundreds of trillions stacked on top of one another. Layered like sediment, war debts, mortgage debts, corporate debts, student debts, each generation building on the last. And here's the question that should make you stop breathing for a second. If everyone owes money, who is everyone paying? Because debt sounds simple until you chase it all the way down. In your mind, there's always a creditor, a lender, a someone on the other side. But when you follow the chain, when you track who owns the debt, you find something colder than a villain. You find a machine. A machine where nations owe money to funds, funds owe money to banks, banks owe money to central banks owe money to the public's belief, and the public owes money to wages that never catch up. It becomes circular, almost surreal. And then the second question arrives, quietly, like footsteps behind you. If the system loops back into itself, how can it ever end? Because that's the paradox hiding in plain sight.
Synthetic voice by VB.VN.
It isn't designed to be finished. It's designed to be continued. And across 3 centuries, 4 men, 4 moments, did not invent debt, but engineered something far more powerful. A system where debt becomes permanent, where default becomes unthinkable, where money is created through borrowing, and where even failure is turned into a contract. This isn't a secret society fantasy. The meetings happened, the institutions exist, the mechanisms are public record. What's hidden is not the paperwork. What's hidden is the meaning. Because once you see how the architecture works, you understand why the headlines, debt crisis, debt ceiling, deficit panic, can feel dramatic and still miss the point. For the people inside the machine, 38 trillion isn't a bug. It's revenue. It's collateral. It's leverage. It's the system working exactly as designed. So let's rewind. Not to theory. To the moments the trap was built. 4 architects. 4 decisions that turned borrowing into a permanent condition of modern life. And it begins in a world where debt still had an ending. Context. Before the trap. When kings could still fail. Before 1694, sovereign borrowing was almost human. Kings went to merchants, nobles, city financiers. They promised repayment, they offered interest, sometimes land, sometimes monopoly rights. And if a king couldn't pay, he defaulted. Creditors lost money. The king's reputation suffered. War plans collapsed, alliances shifted, sometimes thrones fell. It was ugly, but it was contained. Debt was a temporary agreement between 2 sides, and it ended one of 2 ways. Repayment. Ruin. In a strange way, that built-in finality kept the system honest. Lenders feared loss. Governments feared humiliation. The pain enforced limits. And then one man looked at that pain and saw opportunity. Not the opportunity to solve the problem. The opportunity to monetize it forever. Architect number 1. William Paterson and the Birth of Permanent National Debt, 1694. William Paterson was not born powerful. He wasn't a kingmaker by inheritance. He was a Scottish merchant, a restless financial schemer, a man who tried and failed repeatedly to strike gold in an era when gold meant more than wealth, it meant survival. By the early 1690s, England was bleeding money. War with France was consuming the treasury. Tax revenue wasn't enough. And worse, England had defaulted before, which meant lenders had memories. In modern language, England's credit rating was poisoned. So Paterson approached power with a proposal that sounded patriotic, even noble. He would organize wealthy merchants to lend the government a massive sum, £1.2 million. Enormous for its time. But hidden inside the deal was an idea so radical it would reshape the world. The loan would never be repaid. not delayed, not refinanced. Never. Instead, the government would pay interest, year after year, like rent on the privilege of having once received money. And to manage the arrangement, Paterson proposed an institution that would become one of the most influential creations in modern history. The Bank of England. This wasn't just a bank. It was a new kind of political organism. A bridge between state power and private finance, built to make government borrowing permanent. The mechanics were clean, almost elegant.
Experience AI voice technology at vb.vn.
Merchants deposit gold with the bank. The bank lends to the government. The government pays annual interest from tax revenue. The bank passes that interest to the merchants. But the critical detail, the one that changes everything, is that the principal is never extinguished. And merchants accepted because the interest wasn't backed by a king's honor. It was backed by something far more reliable. Parliament's taxation power. As long as England could tax its citizens, the interest would flow. That one shift, linking private profit to the state's ability to tax, was a quiet revolution. Because it meant the creditor didn't need to trust the morality of the ruler. They only needed to trust the government's capacity to extract. And in 1694, Parliament approved the scheme. The Bank of England was chartered. England got its war funding. And for the first time, national debt became not a temporary necessity, but a permanent feature, a pillar of the system. Pattern reveal. Why this was brilliant for finance and dangerous for everyone else. People often imagine banks making money through dramatic scams. But the most profitable financial ideas are rarely dramatic. They're quiet contracts that run for centuries. Let's slow down and look at what Paterson built. At 8% annual interest on £1.2 million, the government owed £96 per year. Not once. Forever. The merchants had effectively purchased an annuity financed by taxes. They didn't need the government to succeed. They just needed it to continue. And if they wanted liquidity, if they wanted their gold back, they didn't demand repayment from the state. They simply sold their banknotes, or later their government debt claims, to someone else. So the debt became transferable, tradable, permanent. And that changes human behavior. Because once a debt claim becomes a tradable asset, it stops being a moral agreement and becomes a commodity, something you buy not because you care if it's paid off, but because you expect it to pay you interest. Then Paterson's real masterstroke arrived. The Bank of England was allowed to issue banknotes against the government's debt. Let that sink in. The government's IOU didn't just sit in a ledger.
Vietnam's top text-to-speech solution from vb.vn.
It became the foundation for new money. Debt was no longer the consequence of money. Debt became the source of money. This is the template. Government borrows. Debt becomes an asset. Banks issue money against that asset. Citizens use that money. Taxes service the interest. The principal survives. Repeat. It's elegant if you're a banker. It's catastrophic if you're a taxpayer. Because you're paying interest on something that structurally cannot vanish. Within decades, Europe learned the lesson. Every major power copied the model in different forms. Funded debt. Central banking structures. Bond issuance. And by the late 18th century, a new country, young, ambitious, and desperate for credibility, adopted the same architecture. The United States. Alexander Hamilton explicitly admired Britain's system, funded national debt, interest paid reliably, bonds tradable, because in his view, that's how a new nation proves stability. And that's the tragedy and genius of the model. It can build empires. It can fund wars. It can create modern infrastructure. But it also turns the state into something that must borrow to function. Because borrowing is now woven into money itself. Paterson, ironically, did not die as the richest man in Europe.
Vietnam's top text-to-speech solution from vb.vn.
History doesn't always reward the inventor. It rewards the system. And the system outlived him by centuries. The Bank of England still exists. British government debt was never cleared, only rolled over, expanded, reshaped. The trap was set. And governments around the world walked into it willingly, because it offered something rulers love more than honesty: immediate funding without immediate consequences. But by the early 1800s, the machine still had a weakness. Architect number 2, Nathan Rothschild and the industrialization of sovereign debt, early 1800s. By the early 19th century, Europe was a battlefield. The Napoleonic Wars weren't just armies clashing, they were balance sheets bleeding. Governments borrowed constantly to buy weapons, pay soldiers, finance allies. But there was a problem. Sovereign debt markets were still messy. Loans were negotiated individually. Rates varied wildly. Only a handful of elites had access. Distribution was limited. Then came the Rothschild network. The Rothschild family began in Frankfurt, in finance and trade. But what made them historically unique wasn't simply wealth. It was infrastructure. By the early 1800s, the Rothschild brothers had established banking houses in the key capitals of Europe: London, Paris, Frankfurt, Vienna, Naples. This created something governments did not yet possess: a transnational financial nervous system. Money could move faster. Information could move faster. Confidence could be manufactured faster. Nathan Rothschild in London became the strategic center.
Experience AI voice technology at vb.vn.
And his innovation wasn't only lending to governments. It was changing how governments borrowed. Instead of simply handing over cash and waiting for repayment, Rothschild used bonds as the product. He would acquire government bonds, often at a discount, then resell them to a wider set of investors. In doing so, he didn't just finance states. He built a market. A secondary market. That seems technical, almost boring. But secondary markets are where debt becomes inescapable, because now the debt isn't a private arrangement between two parties. It's spread, distributed, fragmented across institutions, across borders, across pensions and insurers and wealthy families. And once it's spread far enough, the debt becomes a pillar holding up everything around it. A government gets money fast. A banker earns the spread. Investors get a tradable asset. Everyone feels like they won. Until someone asks what happens if the government defaults. And suddenly, it isn't just one creditor losing money. It's an entire web snapping.
Experience AI voice technology at vb.vn.
The Waterloo story: power through information, and why the myth still matters. There is a famous story tied to 1815, the Battle of Waterloo, Napoleon's defeat. The legend says Nathan Rothschild learned the outcome before the British government did. Thanks to his courier network, he then used that information to trade bonds, selling first to create panic, buying later at the bottom, profiting when victory became public. Some historians debate the exact mechanics of that tale, and the story has been exaggerated and weaponized over time. But here's why it endures, and why it matters even if the details are messier than the myth. Because the underlying truth is real. In financial systems, information speed is power. If you can see the future one day earlier than everyone else, markets become your instrument. And the Rothschild network did have an informational advantage: couriers, contacts, cross-border coordination, at a scale governments struggled to match. Whether Waterloo unfolded exactly like the legend or not, the principle remained: control distribution, control timing, control confidence. By the 1820s, the Rothschilds were deeply embedded in European sovereign finance. They weren't the only financiers, but they represented a new level of integration, connecting governments to investors through a private network.
Vietnam's top text-to-speech solution from vb.vn.
And that network did something quietly terrifying to the last remaining escape hatch in Paterson's system. It made default not merely dishonorable. It made default systemic. Pattern reveal, turning default into a global threat. Before this evolution, a sovereign default could reset the relationship. A king refused to pay. Creditors took losses. The system moved on. But now imagine sovereign debt as a tradable chain. A British bond can be held by a French investor, sold to a Dutch bank, used as collateral for a loan to an Austrian aristocrat, then bundled into a portfolio supporting a pension fund. In modern terms, financial claims stacked and rehypothecated, linked through collateral and confidence. So if a government refuses to pay, it isn't just refusing one creditor. It's detonating an ecosystem. And once debt becomes that interconnected, governments lose a dangerous freedom. The freedom to fail. Because failure becomes contagious. This is the Rothschild-era upgrade to the debt trap. Paterson made debt permanent. Rothschild helped make it interdependent. And when interdependence spreads far enough, you don't need chains. You only need consequences. That's how systems imprison without bars.
VB.VN, Vietnam's leading text-to-speech solution.
By the mid-1800s, the Rothschild family was among the most powerful financial forces on Earth. And whether you view them as villains, geniuses, or simply the best adapted organisms in a changing ecosystem, one fact stands. A major portion of their influence came from sovereign debt. Not factories. Not inventions. Not fields. Paper claims on the future tax revenue of nations. Interest flowing upward, year after year. And by then, Europe had accepted a new reality. Governments would borrow perpetually. And stability would mean paying interest without interruption. But one land across the Atlantic still had a problem. America was rising, industrializing, expanding, becoming a giant. Yet its financial system remained fractured. And when panic arrived, the country learned what happens when a system built on confidence has no central spine. That's when the third architect stepped forward. Not with a philosophy. With a rescue. And then with a blueprint. America before the Fed, a giant with no central heartbeat.
VB.VN, Vietnam's leading text-to-speech solution.
By 1900, the United States was transforming into an economic powerhouse. Railroads, steel, oil, manufacturing. But money was still unstable. Banks operated independently. Reserves were uneven. Credit expansions and contractions came in violent cycles. And the money supply was tightly constrained by gold and by fragile banking practices. This created a world where prosperity could vanish overnight, not because society stopped producing, but because liquidity disappeared. And in 1907, it happened. A financial panic ignited. Stock prices fell. Banks faced runs. Trust companies collapsed. The economy seized up like an engine starved of oil. And into that chaos stepped one man who, for a moment, seemed larger than the government itself. J.P. Morgan, architect number 3, beginning, J.P. Morgan and the crisis that justified a central bank. Morgan didn't save America out of charity. He saved it because the collapse threatened his world, his banks, his investments, his network. But here's what matters historically. In 1907, Morgan performed a role the U.S. government could not. He organized capital. He coordinated bankers. He restored confidence. In the famous retelling, he gathered the leaders of New York finance, pressured them into commitments, and forced a private sector stabilization. And it worked. The panic eased. But the lesson was clear. If one private man could act as the country's de facto central bank, then the country was already admitting something uncomfortable. Real monetary power was in private hands. Morgan was aging. He knew he couldn't be the emergency lever forever. And the next time panic came, the system might not survive improvisation. So the most powerful banking interests pursued a permanent solution. But America had a problem. Americans hated central banks. They remembered earlier attempts, the first and second banks of the United States. Both deeply controversial, both eventually shut down amid populist fury and political conflict.
This audio is synthesized using AI technology from VB.VN.
So if a new central bank were to be created, it couldn't look like one. It had to be disguised as something else. And that leads us to one of the most infamous meetings in American financial history. A meeting that was real, documented, and deliberately quiet. A meeting where the blueprint of modern U.S. monetary architecture was drafted, designed to appear public while operating through private channels. In late 1910, a group connected to Morgan's orbit, including Senator Nelson Aldrich and representatives of powerful banks, traveled to Jekyll Island, Georgia. The secrecy wasn't accidental. They used private rail cars. They avoided names. They avoided attention. Because they understood something fundamental. If the public believed bankers were designing the nation's money system, the backlash could destroy the plan. So the plan became political theater. A central bank that would not be called a central bank. A structure that would look decentralized. A system that would claim democratic oversight while keeping core mechanisms aligned with the banking world. The name itself would be part of the spell. Not central bank. Federal Reserve System.
This audio is synthesized using AI technology from vb.vn.
And once you create the perception that it's federal, you reduce the perception that it's private. But perception is not structure. And in the next part, we're going to walk through exactly how that structure worked, how it made U.S. debt potentially infinite, and why layer crises. From 1929 to 2008 to the post-2020 era, all echo the same design. Because once a central bank can create money to buy government debt, the question stops being, can we repay? And becomes something darker. What happens when the system can't afford repayment, because repayment would destroy the money itself? Morgan to Volcker to the modern loop. Infinite debt. Managed failure. No exit. The Jekyll Island meeting wasn't secret because the plan was illegal. It was secret because the plan was unpopular. There's a difference. In a democracy, the most dangerous designs aren't always the ones that violate the law. They're the ones that rewrite the law in a way ordinary people wouldn't agree to, if they could see the wiring. So on that island, in 1910, behind closed doors, the architects didn't just ask, how do we stabilize the system? They asked a more useful question. How do we stabilize it in a way that keeps control where it already is? Because by then, America had already learned an uncomfortable truth from 1907. When panic comes, the system doesn't look to Congress. It looks to liquidity. And liquidity was controlled by banks. So the solution couldn't be more democracy. It had to be a structure that looked democratic, while preserving the operational power of finance. That was the design principle. And it worked. Context. Why America needed a Federal Reserve. At the start of the 20th century, America's banking system was fragmented and volatile. Money supply tightened when fear rose. Credit disappeared at the worst possible moments. Bank runs cascaded. In a system where deposits were promises, confidence was everything. And without a central backstop, confidence could evaporate in hours.
vb.vn, Vietnam's leading text-to-speech solution.
This was fertile ground for a new institution. Not merely to help the economy, but to own the lever that decides whether the economy breathes. Because in modern capitalism, the greatest power isn't the power to make laws. It's the power to make money plentiful or scarce. Architect number 3, Morgan's disguised central bank, 1913. The political genius of the Federal Reserve System was camouflage. It wasn't called a central bank. It was called a system. It wasn't one institution. It was 12 regional banks. It wasn't controlled by Wall Street. It would be overseen by a board of governors appointed by the president. Decentralized, democratic, federal. That's how it was sold. But structure is destiny, and beneath the surface, the DNA was different. The regional Federal Reserve banks were not simply government branches. They were built with a quasi-private ownership model. Member banks held stock in them and had influence in governance. And the most important node, the Federal Reserve Bank of New York, was positioned where power already lived, the financial capital. In proximity to the biggest banks, the deepest markets, the strongest networks. So the system could say, federal, in the name, while allowing the operational center of gravity to remain in banking territory. Pattern reveal, the moment debt becomes infinite. Before the Fed, Government borrowing had friction. Banks only had so much capital. Investors only had so much appetite. Rates could rise if debt looked excessive. There were limits, imperfect, but real. But with the Fed,
Experience AI voice technology at vb.vn.
the government issues bonds. The Fed buys them with newly created money. The government spends that money into the economy. The bond sits on the Fed's balance sheet. Taxpayers service the interest. This is the modern alchemy. Debt becomes money. Money becomes spending. Spending becomes tax base. Tax base services debt. And because the Fed can always create more reserves to purchase more bonds, a new assumption enters the system. There will always be a buyer. That assumption becomes psychological bedrock. And psychological bedrock is what financial systems are built on. This is why, when you hear the phrase, the full faith and credit, you should understand it isn't poetry. It's the spell. The Fed didn't simply stabilize markets. It ensured government debt could be rolled over indefinitely, because demand could be manufactured. And with that, the trap deepened. Paterson made the principle permanent. Rothschild made default systemic. Morgan made borrowing scalable beyond ordinary constraints. And the timing is almost too symbolic. Morgan died in 1913, the same year the Fed was created. The man left. The machine remained. In December 1913, the Federal Reserve Act passed. And almost immediately, the debt trap evolved from permanent and interconnected into something more extreme.
Experience AI voice technology at vb.vn.
Potentially infinite. Because now, the government didn't just borrow from private lenders. It could borrow into a system where a central institution could create new money to buy government bonds. And when the buyer can print the currency used to purchase the debt, the limit disappears. Modern parallel, how 1913 echoes through 1929, 2008, and the post-2020 era. Once you understand that modern money is tied to debt issuance, the great crises of the last century start to look less like random disasters and more like cyclical stress tests. 1929 wasn't just a stock crash. It was leverage meeting fear. When credit expansion reverses, assets collapse because their prices were inflated by borrowed money. 2008 wasn't just bad mortgages. It was a global collateral chain snapping, mortgage debt sliced, repackaged, and used as foundation for countless financial claims. And the post-2020 era showed it again. When panic hits, liquidity is injected at scale, central banks expand balance sheets, governments issue debt, and the money supply bends around survival. Each time, the story is framed as emergency. But the deeper truth is structural. The system survives by expanding the debt architecture, because repayment or contraction would destroy the money supply that debt created. That's why, paying it off, is spoken about like virtue, but avoided like poison.
Synthetic voice by vb.vn.
Because in this machine, eliminating debt means eliminating money. And that's not a policy choice. That's a design feature. But by the 1970s, something else was happening. The machine had become global. Every developed nation ran on debt rollover. Interest became a permanent river. But developing nations were still vulnerable. They borrowed in foreign currencies. They were exposed to rate shifts they couldn't control. And when interest rates rose sharply, the trap revealed its harshest form. Not just economic dependence, political dependence. That's when the fourth architect stepped in. Not with a new bank. With a new rule. When debt becomes unpayable, do not forgive. Restructure, extend, enforce. Architect number 4. Paul Volcker and the Globalization of No Exit, 1979 to 1982. By the late 1970s, inflation was eating America alive. Prices were rising fast. Confidence in the dollar was weakening. Foreign holders of U.S. assets were watching the currency erode. Inflation isn't just an economic statistic. It's a political disease. Because it tells the public, your work is worth less each year. And no one is in control. Paul Volcker became Federal Reserve Chair in 1979, and he faced a brutal choice. Allow inflation to continue and risk a full crisis of confidence. Or crush inflation, even if it triggers recession and pain. Volcker chose shock therapy. He raised interest rates dramatically. The federal funds rate surged from around the low teens to near 20%, a level that would feel almost unimaginable today. In the US, this crushed inflation. But outside the US, it detonated something far bigger. Because in the 1970s, developing countries had borrowed heavily in dollars when rates were low. Dollar loans looked attractive. Global banks were eager to lend. And many governments believed growth would outpace debt. Then rates spiked. Suddenly, the interest on those loans tripled. Mexico, Brazil, Argentina, others, caught in a vice. Their export earnings couldn't cover the interest, let alone principal. In August 1982, Mexico announced it couldn't meet payments. Default. And this was the moment the global system faced a crossroads. Because default should have meant losses for lenders.
Create professional voiceovers with VB.VN.
It should have meant banks taking hits. It should have meant the system clearing. Painful but honest. But by then, the Rothschild-style interconnection and the Morgan-style central banking framework had created a new fear. Systemic collapse. American banks had lent huge sums. If Mexico defaulted, the losses could cripple major institutions. And if major institutions fell, confidence could cascade. Volcker could have allowed it. He didn't. Instead, he helped orchestrate a bailout mechanism that would become the template for global debt discipline. The International Monetary Fund, pattern reveal, the IMF model, refinancing as control. The IMF didn't arrive with forgiveness. It arrived with continuity. The IMF would lend countries enough money to keep paying interest to their creditors, often Western banks. And those IMF loans came with conditions. Not suggestions. Conditions. What did they demand? Spending cuts. Privatization of state assets. Currency devaluation. Market liberalization. Opening domestic economies to foreign investment. Reducing social programs and subsidies. These were structural adjustment programs. The language was clinical. The impact was visceral. Hospitals underfunded. Public employment slashed. National industries sold. Local currencies weakened, making imports expensive and wages worth less. And the crucial part. The IMF loans didn't end the debt. They extended it. They rolled it over. They kept the interest flowing. This is Volcker's historical innovation in the architecture of the debt trap. When debt becomes unpayable, don't forgive. Don't allow default. Instead, restructure it into permanence. And in exchange, extract economic sovereignty. So debt becomes more than finance. It becomes governance. A lever. A collar. Because once a country's ability to function depends on external refinancing, policy becomes negotiable. Not negotiated democratically. Negotiated in meeting rooms with spreadsheets.
iVoice powered by VB.VN.
Modern parallel, the same script. Different decades. Once you see the IMF restructuring pattern, you begin noticing it across history like a repeating melody. Argentina in the early 2000s. Greece during the Eurozone crisis. Sri Lanka in the early 2020s. Different cultures, different headlines. Same skeleton. A debt burden becomes unpayable. Emergency loans arrive. Austerity is imposed. Assets are privatized. Debt is restructured, not erased. And afterward, the country remains inside the machine. Volcker died in 2019. But his legacy lives in the modern doctrine. Failure is managed, not resolved. Because resolution would require someone absorbing losses. And the system is designed to avoid that. Losses, in this architecture, are socialized. Interest, meanwhile, is privatized. The complete machine. How the four architects stack together. Now we can see the full blueprint, like a mechanism laid out on a table. Paterson, 1694. Make government debt permanent. Pay interest forever. Principal never dies. Rothschild, early 1800s. Make debt tradable and globally interconnected. Default becomes systemic collapse. Morgan, 1913. Create a central banking system that can create money to buy government debt. Borrowing becomes scalable, effectively infinite. Volcker, 1982. When debt becomes unpayable, don't forgive, restructure, keep payments flowing, extract concessions. Together, they didn't create a conspiracy. They created a logic that rewards the same behavior across centuries. Borrow more. Roll it over. Service the interest. Never extinguish the principal. And that logic scales until it becomes the world. Today's loop, the circular debt that feels like reality itself. So what do we have now? A planet running on liabilities. Government debt, corporate debt, household debt, student debt, credit card debt, layered like geological strata of obligation. And here's the part that sounds absurd until you look at it closely.
Vietnam's top text-to-speech solution from VB.VN.
The world doesn't neatly owe a single rich man. It owes money to an ecosystem of institutions that own claims on future income. Pension funds, mutual funds, insurance companies, commercial banks, central banks, and those institutions are often owned, influenced, or managed by the already wealthy. So even if the debt appears circular, the flow isn't equal, because the interest flows upward. That's the hidden river. The mechanism in one country, the US, as a prototype. Take US debt. A huge portion of US Treasury securities are held domestically, by institutions, funds, banks, and the central bank. And those securities pay interest. That interest is paid from government revenue, meaning ultimately from taxpayers. So the loop looks like this. Workers pay taxes. Government uses taxes to service interest. Interest goes to bondholders. Bondholders are primarily institutions. Institutions concentrate wealth through ownership and fees. It's not always a villain twirling a mustache. It's just structural gravity. A system where money is created through borrowing. And borrowing requires interest payments. And interest payments become a steady transfer from broad society to asset holders.
Vietnam's top text-to-speech solution from VB.VN.
Now add the internal, shell game, aspect. Government trust funds hold treasury securities too. So sometimes the government owes itself. But when those securities come due, the money still has to come from somewhere. Higher taxes, more borrowing, or money creation. So even when the debt appears internal, the burden remains external, on the public. The machine doesn't care where the debt sits. It cares that the interest is serviced. Scale it up. Global debt is a shared prison. Now zoom out. Japan owes trillions, largely to domestic holders and the Bank of Japan. Europe owes trillions through banks and the ECB framework. China's debt is heavily domestic, tied to state banking structures. And the web crosses borders. Japan holds U.S. treasuries. Funds hold foreign sovereign debt. International institutions intermediate restructuring. So debt becomes not just a national story. It becomes planetary infrastructure. A circular global system where everyone owes everyone. And yet, the interest flows predictably toward those positioned to hold financial claims. The system doesn't require a single puppet master. It only requires incentives that keep repeating. Why it can never end, the terrifying design feature. Here's the most unsettling truth. If the US paid off its debt completely, the money supply would contract violently. Because a significant amount of modern money exists as debt-based instruments and bank-created credit linked to government securities and broader lending. Debt is not just an obligation. It's a foundation of liquidity. So if you eliminate the debt, you eliminate a chunk of the money that debt created. That would mean deflation, asset collapse, credit contraction, a depression-level event. That's why governments don't solve debt.
This audio is synthesized using AI technology from VB.VN.
They manage it. They refinance it. They roll it over like a ritual. Because debt, in this architecture, is not an error. It's a structural necessity. And globally, the same logic applies. If every government tried to eliminate debt at once, the contraction would be catastrophic. Trade would freeze. Credit would vanish. The system would seize. So debt becomes permanent by design. Not because leaders are irrational, but because the architecture makes repayment destructive. WHO profits, the quiet empire of asset management. Now, look at the institutions that hold enormous portfolios of bonds and financial assets. Large asset managers, names that appear in portfolios and retirement plans, operate as the custodians of trillions. They often buy government bonds using other people's money. Pensions, retirement accounts, insurance premiums, institutional capital pools, and they collect interest payments, management fees, influence through ownership concentration. So the annual servicing of debt becomes one of the largest continuous wealth flows on Earth. It doesn't feel like a tax, but functionally, it behaves like one. A recurring transfer from the productive economy into the financial economy. It's not always evil, but it is power. And power tends to preserve itself. The final truth. Debt as the rent of modern civilization. Here's the final piece, the philosophical center of the machine. The four architects didn't meet each other. They didn't sit in the same room across centuries and plot. But each one confronted a crisis and solved it in a way that favored finance. Paterson solved the war funding problem by making debt permanent. Rothschild solved distribution by making debt tradable and systemic. Morgan solved panic by building a central spine that could create money for bonds. Volcker solved unpayable debt by making restructuring the new default, keeping payments alive and sovereignty negotiable. And then the system absorbed those solutions like DNA. So when you see today's numbers, tens of trillions, hundreds of trillions, you're not looking at a mistake. You're looking at a structure that has been refined for centuries. Because for the machine, debt isn't a crisis. It's a business model. Every dollar of government debt is an asset on someone's balance sheet.
Vietnam's top text-to-speech solution from VB.VN.
It pays interest. It serves as collateral for more leverage. It supports portfolios, pensions, and institutional control. And as long as confidence holds, as long as people believe interest will be paid, the machine continues. The debt trap is complete. Not because escape is forbidden by law, but because escape, in this design, would collapse the system that produces modern liquidity. 4 architects, 3 centuries, 1 machine, and everyone on Earth is living inside it, often without knowing the walls are there. If this changes how you see government debt, then you're beginning to see how modern power actually works. They will teach you debt is a problem to solve. But the architects understood something more unsettling. Debt isn't the problem. Debt is the foundation. And interest is the rent we pay to live in their system.